Welcome to the Deep Dive. We're the place that cuts through the corporate jargon and gets you right to the strategic insights hidden in those dense reports. Today, we're tackling the quarterly report on Form 10Q for American Express. That's AXP. And this covers the third quarter ending September 30, 2025.
Yeah, hundreds of pages, dense figures, but look, our mission is simple. We translate this regulatory stuff into, well, actionable intelligence for you. What's this quarter really telling us about AXP's customer loyalty, their financial strength, and their pretty expensive growth strategy?
Right. And just to set the scene quickly, remember American Express isn't, just your average bank or card processor. They position themselves very firmly as a premium lifestyle brand. Goes way back, founded 1850. So understanding their unique model, it's all about the member. The customer is key. They manage the network and the lending side. And they're doing this in a payments world that's, well, constantly changing. Tech, competition, it's intense. So these numbers, they really show how that premium model is holding up. Okay, so let's jump right into the headlines then, the financials. Q3 2025 looked, well, incredibly strong. Net income hit $2.9 billion. That's a 16% increase compared to last year. Very solid.
Yeah, that 16% jump is pretty impressive, and the revenue backs that up. Total revenues, net of interest expense, climbed up to $18.4 billion. That's an 11% increase. And importantly, that 11% holds even when you adjust for foreign exchange impacts. So it points to real, sustained, organic growth.
And the numbers shareholders watch closely. Diluted earnings per share, that jumped even more, 19% higher, hitting $4.14. So okay, those are the big number. But let's get into the how. Where's AXP finding this growth, this kind of non-cyclical, sustained growth that maybe others in finance aren't seeing right now?
Well, it's really driven by the classic Amex playbook, just sort of amplified. Discount revenue, that's their biggest stream, right, from merchant fees. That increased a solid 7%. Which, basically reflects more people spending more across the network. Simple as that. But here's where it gets particularly interesting, I think. Net card fees. They saw an 18% increase just in the quarter.
Wow, 18% growth just from fees. That shows, well, significant pricing power, doesn't it?
Yeah.
What's behind that? How are they justifying that kind of hike?
It really speaks to the success of their whole strategic approach. That 18% growth, it's mostly coming from expanding their premium card portfolios and, well, charging higher annual fees. These fee increases are tied directly to their product refresh strategy. They add more value travel credits, perks, benefits to justify that higher price tag for the cardholder.
And we also saw net interest income up 12%. That reflects, what, more loans out and better yields?
Exactly. Growth in loan balances and, expansion in the net yield they're getting on those loans.
But I also noticed service fees and other revenues seem to grow quite a bit too. Was that all core growth or was something else going on there?
Yeah, that's a really good point and an important distinction for you to catch. The core fees were definitely strong, but that, let's call it elevated growth, in service fees, it got a bit of a padding from a one-time gain. It was related to an equity transaction involving Global Business Travel Group, Inc.
Oh.
So look, the 11% top-line revenue growth is legit. But yeah, that specific equity gain did help smooth things out and boost that particular services line this quarter.
Understood. So bit of a one-off boost. But the main engine, that membership model, the aggressive pricing power, that's clearly what management's banking on, driving these big results.
And that confidence from management, well, it's really backed up by what the customers are doing. I mean, the Amex model, it only really works if their members are spending a lot, right? Using the card constantly.
Yeah.
And the activity numbers show that engagement is definitely high.
Well, they certainly do. Total network volumes hit, what, $479.2 billion. That's up 9% year over year. Card members spending the bill business, also up 9%.
Yeah.
And the fact that transaction growth itself was up 10% in the quarter, that feels like a strong sign people aren't just, keeping the card in their wallet. They're using it for everyday stuff, too.
Right. And if you break down where the spending happened, you see the premium customers really back engaging in discretionary spending. Goods and services spending grew 9%, mostly driven by strong retail. But the rebound in travel and entertainment, T&E, that's a huge signal strategically. It grew 8%, led by restaurant spending. That's actually their biggest T&E category. And importantly, airline spending picked up quite a bit, too.
So the premium customer is definitely flying, eating out, shopping, big time. And looking at their specific segments, the U.S. consumer services part was notably strong, grew 9%. And the report specifically called out continued strength in spending by millennial and Gen Z card members. That seems key.
Oh, absolutely key. That success in getting and keeping millennials and Gen Z, that's probably the biggest future-proofing move MX can make. I mean, these are high-value consumers. They represent decades of potential loyalty, lifetime value. That's a huge long-term strategy paying off for them right now.
Yeah, good point. And international card services, ICS, that actually showed the strongest growth overall, up 14% or 13% if you adjust for currency. Shows that premium focus is working globally too.
It does. Commercial services was a bit more modest, grew 4%.
So tying this section back to that premium power idea.
Yeah, look at the card metrics. Proprietary cards in force reached 86.0 million. That's up 4%. And because of all those successful premium refreshes we talked about, the average fee per card annualized jumped 13% to $119.
So they're really selling this idea that Amex isn't just, plastic. It's this whole lifestyle ecosystem. And that high fee structure, it kind of acts as a barrier, right?
Oh, yeah.
Competitive moat. It justifies their high costs and makes it hard for others to copy that whole value proposition.
Exactly. Which brings us nicely to the other side of the coin.
Right, the cost. We just saw how high those fees are. But like you said, you don't get premium for free. So what is that massive benefits package, that aggressive acquisition strategy? What does it actually cost Amex?
Well, it costs a lot. I mean, the fundamental sort of tension you see in this 10Q is that card member rewards, card member services, and business development expenses, altogether, they grew faster than revenues. That's the price tag for this aggressive growth in keeping customers happy and loyal.
Well, hang on. So costs grew faster than revenues. They're actually sacrificing margin right now to, buy loyalty and lock in that future value. How aggressive is that trade-off?
Oh, it's extremely aggressive. But it seems very intentional. Let's look at the specifics. Card member rewards expense, up
Yeah.
11% in Q3. That's driven by more spending overall, sure, but also by premium customers really using those bonus categories. The points, the miles we all chase, that's the direct cost.
Okay, 11% on rewards, and the spending on services looked even more dramatic.
Yeah, much more so. Card member services expense jumped a full 25% in Q3.
25%. That's huge cost inflation.
It is, and it was due to people using existing perks more, okay? But crucially, also the introduction of new U.S. Platinum benefits. Amex is deliberately adding more value to their top cards. Why? To justify that higher annual fee and, frankly, to fend off competitors.
Right, and then marketing expense was up too, by 9%, because they kept spending heavily to bring in new high-value customers. They added, 3.2 million new proprietary cards in Q3? So that marketing spend seems to be working, bringing in the right kind of accounts, high spending, good credit quality.
Exactly right. It just confirms the strategy, doesn't it? Refresh the card, boost the benefits, raise the fee, then market like crazy to get more high-value folks willing to pay that price. And even with all this spending, on the capital side, they still managed to return $2.9 billion to shareholders in Q3.
Share buybacks, dividends.
And they did that while keeping their regulatory capital levels stable, their safety buffer. Yep. They kept their common equity Tier 1 or CET1 capital ratio right in their target zone, 10% to 11%. It landed at 10.5%. So that confirms their capital buffer is solid. They've got plenty of cushion for unexpected losses or, just to keep funding growth, even while returning cash to shareholders.
Okay. Let's pivot then to portfolio health. Because for a company that's also a lender, no matter how premium the customer base, credit quality is always, always foundational. So how's the loan book looking?
Credit performance, well, it still looks exceptional. The report calls it best in class, and they credit that premium global customer base. Provisions for credit losses actually decreased by 5% in Q3. Now, that was mainly because they built up less of a reserve compared to the year before. But crucially, the actual net write-off and delinquency rates, they stayed stable. The consolidated net write-off rate was 2.2% in Q3 2025, same as Q3 2024. Stable.
Okay, so on the surface, today's losses look great. Fantastic even. But let's peek under the hood a bit at their risk modeling. They use that complex CECL framework, right, for expected losses. What did their internal crystal ball say about the future economy?
Yeah, and this is where you see an interesting sort of divergence. CECL forces Amex to set aside money based not just on today's stable numbers, but also on their internal, forward-looking, quite frankly, pessimistic scenarios.
Yep.
These models include forecasts for things like unemployment, GDP growth, And while the Q3 reserve builds were mostly just driven by having more loans outstanding, which makes sense, the report specifically mentioned that for the 9-month period, there is a noted deterioration in the macroeconomic outlook used in those reserve models.
Huh, that is fascinating. So their own risk managers are baking in more caution than the current stable write-off data would suggest on its own. They're anticipating potential bumps ahead for the broader economy.
Precisely. They're anticipating potential headwinds that maybe could eventually reach even their premium customers. It's cautious. And just to round that out, their funding base looks really solid too. Customer deposits grew 11% just since the end of last year, hitting almost $150 billion. That's a deep, stable, low-cost way to fund their lending.
Right. Okay, so let's try and tie this all together then. What's the one sort of defining strategic message for you, the listener, from this quarter?
I think the defining message is really that tension between investment and loyalty. Amex is spending aggressively, very aggressively, to maintain that premium status. You see it in the high reward costs, the high benefit costs, and that investment is working. It's translating into strong, sustained revenue growth, phenomenal spending growth, especially with those key millennial and Gen Z groups. They seem willing to compress their margins in the short term to really secure that long-term, high-value customer loyalty.
A clear strategy now.
Mm.
Spend now to keep the best customers and attract more like them, even if profitability today doesn't look quite as stellar as the top-line revenue growth.
Correct. But okay, here's the final thought, maybe something for you to mull over. We noted that while Amex's actual credit quality today remains stable, best in class even, their own internal models flagged a deterioration in the macroeconomic outlook over the 9 months, right? Forcing them to hold bigger reserves. So, given that different stable data today, but a cautious forecast built into the balance sheet, you have to wonder, is all that high spending on rewards and benefits just the necessary cost of loyalty these days? Or perhaps is it a sign that maybe even the premium customer base could be more sensitive to a real economic downturn than Amex's history might suggest? Should we expect them to be totally insulated? Maybe that spending is what's needed to keep them loyal if times get tougher. Something to keep an eye on, definitely. Those service and reward expense lines, they could be a leading indicator of how hard Amex feels it needs to fight for retention.
That's a great question to leave us with. And that is a wrap on this deep dive. We hope this gave you the shortcut you needed to really understand American Express's aggressive, high-stakes Q3 2025 story. Until next time.